CME, pricing in just one cut this year. You're much more optimistic. I would say contrarian. You see 3 cuts. How does that happen? How does that all unfold this year with so many other people only seeing 1 cut?
Well, the great thing about economic outlooks is you can always make adjustments to them over time. So the fact that we're on 3 today doesn't mean necessarily that we won't be on 2. 1, I think, is probably not enough. If you recall last year, a number of groups were at 7, and we were not. So I think we've been more conservative coming into this. But look, there is real merit for them cutting rates, but it's probably not going to happen until something in the June neighborhood. So we'll be patient.
All right. I just want to get your take on the market so far year to date. If you look year to date, the biggest laggard last year, that was energy. It's the leader now. Tech, which has been pushing the market higher, that's actually the laggard. What do you make of this divergence and change of leadership, at least to start the new year?
Well, I think there's an expectation for the incoming administration that there'll be some change in policy that will drive solid growth. There's also a valuation. We talked last year, everyone has, about how expensive the market is, especially in tech, and energy was at the bottom. Anytime you showed an array of sectors, energy was at the bottom. And so the fact that there's a little bounce off the bottom is just that. It's a bounce off the bottom.
All right, so we're also seeing a big change in flows. Morningstar out with a new report today, looking at the inflows into the RSP. That's the S&P Equal Weighted ETF. So for the year, $17 billion of inflows, full year. But the second half of the year, $14.4 billion. A lot of investors obviously worried about concentration risk. When you're looking at the markets, you're talking to clients. Are you worried about that concentration risk, and how do you mitigate it?
I think there's a way to balance it. Look, the Magnificent Seven has gotten the acclaim that it has and the flows that it has because there are earnings. And when you look at earnings growth coming from the S&P, solid expectations for 25, mid-teen year-over-year growth in earnings. But when you break it down, most of that is coming from the Magnificent Seven. So yes, premium valuation, but they're also driving real earnings growth. So if you're investing for growth, you have to have some of that. Not a lot. We're balanced about how we have exposure, but you need some.
But are you advising to lessen exposure? So you're talking about earnings. I want to talk to you about something else, the rise in the dollar. Over the last 3 months, up over 5.5%. Again, those mega cap tech stocks, the Mag 7, they get a lot of their revenue from overseas. They're certainly expected to be impacted by that rising dollar. When you're talking to clients, are you reducing exposure to the Mag 7 and big tech? Are you putting the money in some of those beaten down sectors like energy, expecting the bounce that we're seeing?
There are opportunities to make some adjustments. I would say that clients and taxable investors in the U.S. hate one thing, and that's paying taxes. And if you think about what technology stocks have done over the last few years, there's taxes there, so you need to be careful about that and balance the costs. But yeah, there is a potential to make a rotation today. I think, look, the dollar strength that we're seeing is the cleanest expression of a Trump win and expectations around what the administration is going to create. We called in November to say, buy dollars, buy dollars, buy dollars. It's been the right call. Could we get to parity of the euro, for example? I think that's certainly within the range of outcomes that we think is somewhat likely. But it doesn't necessarily diminish the strength of these tech companies. That 15% growth rate for the S&P, that considers the dollar strength that's taking place.